Folks, it's Tuesday, November 17th. It's Guy Adami. I'm with my dear friend Dan Nathan back for the macro setup. This macro setup brought to you by Nadex, the premier U.S. exchange for trading binary options, knockouts, and call spreads. Dan, we have a huge guest. We actually have two guests with us today. We have Dan Cook in charge of business development at Nadex, but we also have Peter Boockvar. And, you know, one thing I said to Peter before we came on, there's a great Led Zeppelin song, All of My Love, and one of the lyrics is, one voice is clear above the din. Well, guess what, folks? Peter Boockvar is one of those voices. It's clear above the din. And Dan, I'm going to let you make that introduction.
Yeah, well, it's great to have Peter here. You and I have known Peter for probably about a decade from his appearances on CNBC. He is a tour de force. He is the CIO of Bleakley Advisory Group and the editor of the Boock Report. It's a daily read for me, the Boock Report at thebookreport.com. So check that out. Peter, great to have you with us. Thanks for joining, man.
Thanks for having me. Dan and Guy, two of my favorite people in this business. So I really appreciate getting a chance to chat with you guys.
Well, we do this offline with you every so often, not enough to be very frank, but we thought it'd be great for Guy and I to check in with you. You know, there's been obviously a lot going on the macro front over the last few weeks here. You know, obviously the election, the transition, the upcoming runoff, and the implications of what that might mean for fiscal stimulus, monetary policy, regulatory policy, a whole host of things that really affect a lot of the underlying risk assets that we trade. So we just kind of wanted to check in. Where is your head right now as far as we're concerned? Or I think the consensus is that the election is over, aside from that runoff in January in Georgia that could decide the fate of the Senate, and it could have implications on fiscal policy, that sort of thing. But where are you right now? Because we have about 2 months, and it seems to be there's a bit of a no man's land on the policy front, and the president's inability to kind of concede the election is kind of slowing up maybe some of the efforts that it might take to get that stimulus or to get the vaccine logistics, you know what I mean, going here. What's your take on this? And do you think this is a significant period for the markets, especially with the S&P 500 yesterday and the Dow closing basically at all-time highs?
Well, I think because of the vaccine, I think a lot of negative news we'll see in the next couple of months with the shutdowns. And if we don't get a stimulus, or I don't like to call it stimulus because it's really just filling holes, but a spending package, the market will look past it and say, okay, 2021 will be better. I think that when you look at whatever fiscal spending we're going to get, I think we need to narrow down what would satisfy the markets. The market really just wants the added unemployment benefits. I think even if you just pass that, the market would say, okay, we're sort of putting some money in people's pockets that don't have jobs, and that would buy us time until the vaccine gets fully rolled out, because that's what this is about. It's just about buying time. It's just going to pull forward some activity that would have happened otherwise next year when the vaccine gets fully rolled out. So that's what I'm really more actually focused on. I think with the election, the Senate election, I think that there's a very low assumption that the Republicans will lose both seats. So we have to assume that we're going to have a split Congress. Therefore, we'll have at least some visibility on tax policy over the next 2 years. And on the flip side, whatever happens at the regulatory and agency side, we'll see how that plays out. But I think that we need to get out of the 2020 mentality and think about what 2021 is going to look like upon this vaccine. And it's very easy to say, oh, the election's over. Divided government, we have a vaccine, everything is great, but it's why we're at 3,600, why everything is great. And on March 23rd of this year, when we were staring into the abyss with the shutdown, but that was actually the best time to buy stocks. And in the background of people's thinking, but front and center of why the markets have done what they've done, is because the Fed cut rates to zero. We have massive QE, and the Bank of England, the Reserve Bank of Australia, and Canada, and the ECB and BOJ all joined this party. Well, they all joined this, and they all did this because of COVID. Well, if COVID is in the rearview mirror at some point in 2021, well, they can't continue on this, scorched earth stimulus policy on the monetary side. They need to start pulling back, and I think that is going to be actually the main story for 2021. That the monetary side all of a sudden becomes a headwind. Inflation becomes a headwind, higher long-term interest rates potentially become a headwind, while at the same time the economy should have a nice rebound and our lives can start getting back to normal. I know it's counterintuitive for some people, But just look at 2020. It was the perfect example of the markets not being the economy not being the markets.
Yeah, it's a great point, Peter. And again, your work is extraordinarily thoughtful, and it's something that is must reading. I think if you're in the business or if you have interest in the markets, just what's going on. And I think you bring up a great point. And I go back to October 2018. I think Jerome Powell was a couple months or so into being the Fed chairman, and I know you remember this, but he basically said something, and I'm paraphrasing, that we're going to get back to some sense of normalcy in terms of interest rates, and in terms of the balance sheet, it was going to be sort of on autopilot in terms of whittling down the balance sheet. And I submit, and correctly or incorrectly, but my opinion is he was absolutely on the right path then. The only thing that stopped him from following through was the fact that the stock market in about a month and a half went down 19.9%. And to your point, you just made the point that if things get back to normal, they're going to have to stop this scorched earth policy. I would push back and say, yeah, they should. But if the market behaves poorly, are they a slave to the market?
Well, there is no question that the Fed will way overstay their welcome with what they've done, and they'll use every excuse for that. Last time, the recession ended in 2009, and Janet Yellen didn't raise rates until 2015. And in between, we had a few extra rounds of QE. So I agree that we shouldn't expect any central banker to sort of be ahead of the curve. But because of the inflation that I expect to see, and that we're already beginning to see, sort of the tinder and the embers and the beginning of it, that the long end will actually tighten for them. And the Fed's sort of free will and what they think they can do will sort of get taken away if I'm right on inflation. If all of a sudden next year, because of an improving economy, we start printing 3/10, 4/10 monthly CPI because goods prices are going up, and all of a sudden hotels and restaurants and airlines all of a sudden have pricing power because everyone wants to start getting back to their life. Well, then the Fed is going to be left on their heels and sort of forced to respond. And that's actually a situation they don't want to get into, but they put themselves in there because they never go to where the puck is going. They're always just very reactive.
So that's a good opportunity to kind of talk about a little bit. You mentioned this point about, once investors can start to kind of price in what the virus looks like in the rearview mirror, we're going to basically start normalizing earnings. This is what obviously S&P 500 should be trading off of, that sort of thing. But I guess I wonder is, like you mentioned the word pull forward in demand. So are we likely to see a bit more of kind of a sluggish rebound in 2021 or a great deal more sluggish, right? Pulled forward a lot of demand, especially at a time where we're going to probably have 6 to 9 months in between that last bout of fiscal stimulus, the expanded unemployment, and some of the other things that they're trying to do. And I worry if that, like you just said, that's why we're at 3,600 in the S&P 500. Have we pulled forward returns in the S&P 500? And what does that mean for valuations? And then let's get to some charts.
Well, on the market side, so based on the estimates we're seeing already for 2021, which essentially gets us back to where we were at the end of 2019, you're trading at 22 times 2021 earnings. I think of note is you're trading at basically 18 times 2022 earnings. So you're very expensive on those metrics. Obviously, low rates and all the QE helps to substantiate that in people's minds. But if you get a better economy next year, which a lot of those estimates assume the better economy, the PE multiple does not assume a shift in central bank policy. So that is where that could be the determining factor on what markets do next year, is what that multiple should be. Should it be 22 times? Well, if we're going to see higher long rates, because I believe that the economy is not, the 10-year yield is not going to sit there at 90 basis points while we have a mass inoculation in the US and abroad. It's just not going to happen. And the inflation numbers we're seeing now, which have already ticked up, and in fact, the CPI index, putting aside rate of change, the CPI index has already exceeded its pre-pandemic levels. So there's no deflationary bust this year. There's no deflation that people like to talk about. CPI and PCE are at the highest level they've been. So that's the setup for next year. And then all of a sudden, what happens if you trade at only 20 times earnings, or 18 times earnings, or 16 times earnings? Well, you can still get that EPS number. You can still get that economic rebound, well, the market will be lower because you get a PE multiple rethink because interest rates go up, not because the Fed is bringing rates are higher, but because the market's going to do it instead. Now, in terms of pull forward on the economy, well, the interesting thing about 2020 is that people shifted their spending behavior to the good side and away from the services side. Well, if you had all these people that bought PCs this year because they all worked from home, well, they're not buying PCs next year that they just bought in 2020. You don't upgrade a PC every single year. And a lot of people that went to buy used cars or even new cars because they moved to the burbs, well, they're not going to buy at the same pace in 2021, but they'll shift, hopefully, their spending back to services and going out for dinner a few nights a week and spending on vacations and other services, sporting events and concerts that they didn't do in 2020.
Yeah, it's interesting, and that's the rub. And we're going to call up our first chart, which is obviously the S&P 500, and we're going to pull it up here now. But as we bring this up and we can speak to this, one thing I've said, and I'm not suggesting I'm right, but just my opinion is there's inflation in all the wrong places. The Fed just chooses not to measure those places. Meanwhile, you have deflationary forces in the form of technology, which is something, technology is the biggest deflationary force in the history of mankind. So they're fighting this two-headed serpent, and they're losing, in my opinion, and it's going to manifest itself in a really dangerous way at a certain point. And anyway, I think I'm sort of echoing some of the things that Peter is saying. I know Dan is obviously with us, and we have the first chart is the S&P 500, and obviously yesterday we breached that all-time high, as Dan mentioned. Today we see ourselves pulling back. I look at this chart, Dan, and I say, despite the fact we had that seemingly blow-off top last Monday and again yesterday, you're still sort of in line for what potentially is a decent double top, and that February high of 33.93, that previous all-time high, is still in the crosshairs. And we're going to talk about the VIX as well, Dan and Peter. But when the S&P 500 made its prior all-time high back in February of 3,400 or thereabouts, you're talking about a VIX that was 14. As we speak here today, we had a VIX that traded down to 22 yesterday, is north of 23 today. So something clearly has changed. But Dan, you look at this chart, what's it telling you?
Yeah, I don't love 11% up in a straight line based on potential outcomes prior to the election, where a lot of people were saying that, there was no way the market went down. So here we are, you had this kind of FOMO chase where, on November 4th, 5th, everyone is deciding that every outcome is bullish. I brought this point up in the beginning of this conversation, just saying that this transition, right now, we haven't really even started. The New York Times broke a story that President Trump was considering as soon as, or as recently as last Thursday, bombing Iran, bombing nuclear sites. So I'm just saying that I think this is, and he's still tweeting out, I won. I think we're not out of the woods yet on some of the kind of, just some of the politics here and what that means. I'm just shocked that the S&P is where it is. I look at that and I say that 33.93, the February high, looks like pretty decent support, but the 32.10 area from the late September lows, and we almost retested that earlier this month. Obviously, that's really good support. That's a fairly big range there, obviously, because we just went up 11% in a straight line. I want to bring up the 5-year chart really quickly, and then I want to get Peter's take on that. Obviously, that's not a log chart, but draw a line from that early 2018 high. The 2018 period is really interesting to me because that's when the trade war started. That's also when the tax cuts went into effect in early 2018. And if you recall, that was a pretty long slog. We had that move into the new year, and then we went straight down about 7-8%. And it took us about 10 months to make a new high. And then all of a sudden, interest rates were starting to feel what was happening in the economy. We had the 10-year, over 10% or over 3%, Peter, and then we went down 20% in a straight line. And that's when the Fed had to do a massive, massive U-turn and ignited a huge rally right into this February. So what is your take on these two charts of the S&P 500? And then we'll go to Guy on the VIX.
Well, I'll start by saying that we have two markets. We have tech and we have everything else. Yeah. And we know very clearly that tech has been the predominant driver of these S&P charts. So whereas tech in 2020 benefited so greatly from work from home, well, you can't assume the economy is going to reopen next year, that tech is just going to perform in that same way, both from an earnings growth standpoint and also a multiple standpoint. I mean, you take Apple, for example, well, maybe they'll sell a lot of 5G phones next year, but they're certainly not going to sell as many Macs in 2021 after the amount of Macs that people bought in 2020 when they worked from home. So getting the direction of tech right will help you figure this out. Also, taking a step back, you look at over the last 10 years and getting to the point that you mentioned when the Fed were raising and then had to do their pullback. And to my point about central banks not being they're the same sort of friends next year as they were in 2020. Every single notable pullback since over the last 10 years have been around when QE ended and when the Fed started raising rates. When QE1 ended, the market fell about 15 to 20%. When QE2 ended, we fell about a similar amount. When right around the time, right before QE3 ended, we had a 10% fall. When the Fed first raised interest rates in December 2015, we had a major hiccup in January, February of early 2016. So, and then we obviously know what happened in the latter part of 2018. So it's the sort of dependency that the markets have had of gimme, 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 all that stimulus. But once that stimulus starts to slow down, then you actually have a market reaction. And while next year, there's certainly going to be a lot of air going into that monetary bubble, if less air goes in, then that monetary bubble then starts to shrink. So that's why I continue to believe the direction of rates, the direction of inflation is going to be a key determinant of where markets go next year. But it is that vaccine, it is a better economy next year that drives those inflationary impulses. And you look at commodity prices, all commodity prices have rallied except crude. Even natural gas has rallied. Food prices are at multi-year highs. Raw industrials are at multi-year highs. Now you get people next year driving more and flying more, and you get a lift in crude prices because you've seen a very sharp crimp on the supply side. Well, then inflation is going to be more of a story. And to Guy's point, yes, technology for centuries is a deflationary force. So over centuries, there is always going to be deflation. As we do things better, we do them more efficiently, more productively. So inflation is more of a cyclical event. It's more of a bad policy event. When I say bad policy, it's governments that ramp up budget deficits and spend too much and have poor monetary policy. Well, to me, that comes together next year was we have too much excessive budget deficits, all this monetary financing of that, and major supply disruptions that COVID created. They're not easily fixable. So when I talk about my expectations about higher inflation, it's more of just a cyclical event, knowing that the long-term demographic trends and technological trends are on the deflation side. Now, that said, that's really on the good side. Services side seems to be perpetually higher, and that in the aggregate, the CPI index forever seems to be going up. So you tie sticky services inflation with a cyclical increase on the good side, and that's where you get sort of this inflationary mix that if rates do go up, not central bank driven, but market driven in a very well over-indebted global economy, that's a potentially a mix that needs to be digested.
Yeah, sure. It's an unhealthy brew, as they say. I'm not trying to put words in your mouth, but that's my opinion. And it's fascinating to see. It's sort of be careful what you wish for if you're the Federal Reserve, because you just might get it. And I've said that a number of times in terms of some of the things that President Trump has talked about and said, and that's not talking politics. So I'd love to go to the next chart, Dan and Peter, if I can. And I think it's obviously the Nasdaq, which is going to look similar, but I think interesting as well in terms of levels. And if we could sort of, as they used to say in match games, slide it, Earl, and we'll pull up this chart of the Nasdaq if we can. But I think what it's going to show is you had this huge uptrend followed by a move to the downside. Obviously, that huge move back to the upside, testing that uptrend line. And, I would submit, just my opinion, again, we're going to fail here. And Dan, we've talked about this for a while, but we saw that uptrend. We saw a break of the uptrend. We both thought we'd see a retest of the trend line, which we did. We didn't think we'd get back to 12,400, but we thought certainly 12,000 was in the cards. We got that subsequent sell-off. I think this rally back to 12 is going to fail. I think there's going to be a move from growth to value, and that's going to really put I think are hurting on the Nasdaq. Dan, you look at this. What are you talking about? What do you
Yeah,
see?
I see further consolidation. I think Peter makes a lot of great points about within the Nasdaq, this kind of the differential between goods and services, and we know the multiple that the services side is getting is pretty high. But if you look at the top 5 names in the Nasdaq 100, that's what we have right here. They make up 45% of the weight of this index. They've all massively outperformed the S&P 500, many of their peers, obviously driving the outperformance, the NDX. That high on November 9th, and we had that big reversal in the NDX, that was almost to the penny of the high in October, which was not above the September 2nd high. So to me, I think you have a range bound NDX. I want to say something anecdotal here. I bought every iPhone that's come out every year since it was released in 2007. This one right here, okay, is the cheapest one that I've bought. Peter said, well, they may sell a lot of 5G phones next year. I bought one. It was $800. Now, I bought it on their iPhone upgrade program, and they like the recurring revenue. That's a different model for them, but it is not that $1,000 price point that I've been spending over the last few years. And so I guess the point about technology, we know this about hardware, there comes a time where they just become a commodity. And that might be what people are talking about, this iPhone 5G super cycle. It may be the most commoditized cycle that we get because the form factors aren't changing much. The cameras aren't changing much. The pictures aren't changing much. The speed's not changing that much. If it's just the network speed, well, there's a lot of things that have to happen there. Just ask T-Mobile and AT&T and Verizon to make it worthy of that. So I think we might have hit a tipping point. That being said, I would have said that Netflix was never going to be able to raise prices again. I got an email this morning saying that my price is going up $2 a month from $15.99 to $17.99. So the services guys have pricing power right now. Maybe it's the goods that have less so. So, the NASDAQ, to me, I think they come back to it despite the fact the big names, even though that they are maybe correcting in time and maybe not so much price of the last month, they're still not above those September 2nd highs. So the NASDAQ 100 to me is what they come back for after this rotation into value and cyclicals. Let's hit the Russell real quickly. And I'd love to get Peter's take on the small caps. It took them a long time, 2 years to make a new high. That high earlier this year that we collapsed from in the Russell 2000 was not the all-time high. It had not made a new all-time high since early 2000. Russell here, and how do you see small caps versus large caps playing out over the next year or so as we get inoculated?
Well, on the large cap side, as we talked about valuations, one of the sort of canaries in the coal mine that I did talk about back, it was October 15th to be exact. It was when Fastly reported earnings, the stock that went from about $20 in March to almost 130. It was trading at 40 times sales, and they didn't meet earnings estimates. Part of it was related to their business with TikTok, but regardless, the stock got hammered, went down almost 30% in one day, and then fell 50% over the subsequent weeks. And that told me, well, maybe markets all of a sudden care about valuations of these big cap tech stocks. On the flip side, you can look at the Russell, which obviously has much less technology, has more of a financial bank bent, along with natural resource companies and others, that you consider that in a sense it's almost like a value index, that if markets are going to start paying attention to multiples again, and that a 40 times sales multiple matters relative to one that's 30 or 20, which means that the stock falls 25 or 50%. Well, on the flip side, value all of a sudden matters, and a low P multiple all of a sudden matters, particularly rates, which obviously are not high on an absolute basis, but the 10-year yield at 90 basis points, it was 60 basis points not too long ago, and that we're going to get the shift. And I do think this shift is going to continue. Small caps will be a beneficiary of a stronger economy, which I expect in the second half of next year, when again we get back to normal. And technology, which benefited so greatly, we know, in 2020 because people worked from home and were stuck at home. Well, there's less reason to pay the same multiple for Zoom the day after a vaccine than you were paying the day before a vaccine, because the secular trend for using Zoom is going to go up. But at least I know if I'm going to have more face-to-face meetings, I'm going to use Zoom less, just by the math of your interaction with people.
Yeah, it's interesting. And I'm glad we have this chart up. I'm going to go to rates because, to Peter's point, I mean, the Russell really is just a factor of people believing that we're in this improving economy. And if you basically look, the move in yields from, to Peter's point, basically 60 basis points or even lower, by the way, maybe 53 basis points in the 10-year to current levels, it basically mirrors the move in the IW or the Russell. And, you know, you have a very defined move to the upside, and that's predicated on rates going higher. And I think in terms of trading, folks, you have something to trade against if you want to continue to play it on the long side against that prior high in 2018. So a very well-defined risk reward. So I'd love to bring up the 10-year if we can, because I think this sort of speaks to exactly what Peter's speaking to. You know, I look at this and I see us trading up against the levels we topped out back in June, probably 95, 96 basis points or so. And here we are again. Do we top out here, Peter? And I know Dan has an opinion, or do we sort of consolidate and make the next move higher, which is probably to the levels we saw back in March when you saw that huge spike in yields?
Well, it's on one hand, it's easy to say, well, if the market is back to where it was in January, February, even above that, why can't the 10-year yield be at that level too, of 1 3/4, 2%? Now, of course, the Fed funds rate wasn't zero then. So what the Fed has done is going to be a weight on how much that 10-year is going to rise. But I do think the trajectory of that 10-year is still going to be up. I mean, looking at that chart, you can easily go back to 120, I believe, with the blink of a finger. I mean, I've argued that with the mass rollout of this vaccine, the global bond market's the sale of the century. I mean, we have global rates. We have $17 trillion of negative yielding securities because of COVID and this pandemic. And you get out of that, and all of a sudden, everything fixed income becomes a risk. Again, because of the possibility of higher inflation as the economy improves next year. And these central bankers just at least calling a timeout from doing more. I mean, we're sitting here, we've had great vaccine news over the past 2 days, and we're debating whether the Fed is going to do even more at their December meeting. I mean, where is their foresight about what 2021 is going to look like when 2 vaccine companies tell you that the efficacy is 90% plus? So obviously they're not looking ahead, and they don't remember that after QE1 and QE2, long rates actually went up because people said, oh, yeah, the Fed is reflating. Well, what happens if that happens again? The Fed starts buying longer term treasuries and extending out their QE, economy gets better. The 10-year yield can go up a lot. And one of the examples I like to give of you know, the broad consensus is rates can never go up. Rates will stay zero forever. There'll never be inflation of note, and that the world can be great, but rates are just going to stay stuck here. In 2015, when after the ECB went to negative interest rates and they were already well within QE, the German 10-year yield went from 6 basis points to 1% in 2 months. From 6 to 1% in 2 months. So, and that's no developing economy. It's obviously hugely developed. So I think people are going to be surprised by the dislocations that we potentially could have in global sovereign bond markets next year when global economies improve dramatically upon this vaccine and the mass inoculation, and that central bankers are just going to be caught completely off guard, and that their wish of higher inflation they're going to eventually regret.
Yeah, but Peter, I just want to push back on one thing here. You know, when you think about it, I read an article this morning in Bloomberg talking about zombie companies, just the debt that was raised in a lot of these hardest hit, areas. That was obviously one of the reasons why the Fed hit the rates hard in February and March and jawboning them the whole way down, right? And really making it easy enough so companies that were troubled, could borrow and could make it through to that period that we're talking about. So, Fed Chair Powell spent much of the summer and early fall just begging Congress to do a deal, right, with the White House to get some fiscal stimulus going, to take some pressure off them. I really feel like listen, I think we're all children. When we look at this market and we look at how we're reacting to the news over vaccines, how we've been reacting to news over tariffs, how we were reacting news over stuff for years now. Okay. Like, listen, Fauci just said it the other day. The population is not going to be mass vaccinated for months and months and months. So what happens between now and then? And that's why I think it's really important, because if interest rates start going up, that's going to make it higher, the debt service for a lot of these companies, right? So I don't know. I don't know. I get it. I mean, people have been saying inflation's coming for, 12 years, and that, we haven't seen it. If you just take a line and you take a ruler, it's upper left, bottom right for rates, and we bounce back to the downtrend, but we seem to get rejected every single time, right?
Right. I mean, this is something that plays itself out. It's not an event. It's going to be a
Yeah.
process.
Yeah.
And we've already seen that process in some of the inflation statistics. When you look at it's they're double digit. Now, I know I'm going to pick and choose here some price changes, but
Yeah.
this gives you an example that there are inflationary pressures out there that we just need to be mindful of,
Yeah.
and that could manifest itself. Now, to your point about mass inoculation, I'm talking about the second half of 2021.
Yeah.
That will show the real economic improvement, and I hope, just from me as a consumer, and Dan, I know I hope to see you there at a concert this summer.
Yes. Yes.
That there'll be there'll be aspects that will come back faster than we think. Hopefully this summer, which in the scheme of things is only a couple of quarters away. So
Yep.
there's no question that we have a rough couple of months for sure. But I think the market is going to be looking past that. And maybe it's not until the latter part of the first quarter or the second quarter that we get the move up in the 10-year to 1.25, 1.5. But I think when it does happen, it's going to happen. And it's going to, initially, I'm sure the stock market will say, oh, yeah, long rates are going up for the right reasons. I mean, we've been doing this a long time. That's always the case. When the Fed starts raising interest rates, oh, it's okay. The Fed's doing it for the right reasons. And then eventually, because of all the debt you talked about, something breaks.
Yep.
And it's always difficult to know when that something breaks. But we know when central bankers at least stop what they're doing, when they stop expanding their balance sheets, when rates do go up, it's okay for a period of time, but then eventually something breaks because of all the debt that we have out there,
Right.
and because of the excessive multiples we have in many parts of the asset markets.
No,
Right.
it's a
Well,
great point. Oh, I'm sorry, Dan.
It's a good pivot here. Let's Guy, why don't you wrap us up with Peter
Well-
with the Dixie, the US dollar, because obviously this is pretty interrelated. And I know a lot of viewers on this podcast are very interested. They trade the dollar versus a lot of crosses, but let's just talk about the Dixie here, banging along, 3-4 month lows right now. Guy, do you want
I
to
think
give
it's
your
really
little,
important.
yeah.
And I think Peter has a view on this, and we've taken a lot of Peter's time. And listen, obviously on behalf of Dan and Nadex, I thank you so much, Peter, for joining us. But I look at the dollar and I say, you say an improving economy, rates can go higher, and I agree with that. But then you look at the dollar and it's telling a much different story. So, Peter, I would just, in the final few minutes, I would ask you, if you see rates go higher and the dollar go lower, I've said for a number of weeks that that's sort of a witch's brew, because quite frankly, the opposite should happen. But here we are in the dollar index, banging against levels that have been huge support. I happen to think we're going significantly lower. I think Citi just put out a note saying they see 20% downside for the dollar in 2021. Again, I'm not asking you to be a stock market player here, but what are your views on the US dollar here in the final few minutes?
So you look at the dollar, if I'm right on the inflation story, well, that's usually dollar negative. And when you look at the dollar, against the euro, for example. The euro has negative interest rates. The ECB is a bigger balance sheet than the Fed, certainly is a bigger percentage relative to GDP than the Fed. Sclerotic growth, the welfare states that barely see 1% to 2% growth. And the euro has traded great for the last 5 years in the face of that. The Bank of Japan is literally lighting yen on fire. And look how well the yen trades. I think the pound goes back to 140 when they sign this Brexit deal. You look at the dollar versus the Canadian dollar and the Mexican peso, two of our largest trading partners. The dollar has basically done nothing against these currencies over the last couple of years. And you have a socialist running Mexico, and with all the problems that Mexico has. And then you look at the dollar against Asian currencies that contain this virus much better than we did, have seen a much quicker rebound in economic growth. And that's why the Asian currencies are trading at the best levels against the dollar in a couple of years. So you've had plenty of reasons for the dollar to rally. And really, it's rallied against the Turkish lira, the Argentinian peso, the currencies, the Brazilian real, the currencies that are really troubled. So that tells me that the dollar, big picture, has issues. If you look at a big 20 to 30-year chart of the budget deficit relative to GDP versus the dollar index, they pretty much mimic each other. And if we don't get control of our budget deficit, the dollar is going lower. And again, if I'm right on inflation, another reason for the dollar to go lower. And with the economy is going to rebound in the US, it's going to rebound globally. So it won't be just us that benefit. It'll be the whole world will benefit from the economy. But lower real rates, I think, will be the story next year. That'll be dollar negative, and that'll be positive precious metals, commodities, and other things.
Peter, so with you, for you folks playing at home, in terms of levels, that sort of 91.5 level on the dollar index at DXY is a line in the sand. I happen to think we're going to break it. We'll see what happens. But listen, Peter, thanks so much for being so generous with your time. It's been enlightening, to say the least.
Yeah, check out the book report. Honestly, you can find it on Twitter. Follow at P Boockvar, right, and at the book report. It's a great read every morning. Keeps you up to date on all these topics that are great inputs for your macro trading. So, Peter, thanks a lot, man. It's great to catch up with you today.
Thanks. I appreciate it, both of you guys.
Thank you.
So next, Dan, we want to bring in another Dan. We want to bring in Dan Cook, the head of business development at Nadex. He has some really exciting opportunities and programs they're running at Nadex. Dan, hopefully you're with us. I like to see your face popping up on the screen. Say hi to Dan Cook, Dan, Nathan.
Hey, Dan, thanks for joining us. You guys have an exciting trading competition going on. Guy and I were fortunate enough to speak to some of the people yesterday during a webinar that you guys hosted during this competition. And Guy and I just said, we were on with Travis, and we were just saying these sorts of competitions, paper trading, kind of figuring out how to implement your strategies before actually taking that risk, figuring out what the inputs you're going to use, how do you use stops, how do you use the system, all make a lot of sense from Guy and myself's perspective, especially those new to trading. Love to hear more about what you're doing with the competition and how you're looking to help your customers.
Yeah, absolutely. And first of all, thanks guys for having me on. And Guy, that's the first time I've ever heard anybody say it's good to see my face pop up. So that as well. Yeah, the trading competition, very exciting. We've got thousands of people participating. It is in the demo environment. It's a great way to learn the platform, but also the unique structure of Nadex contracts. It's not a different market. So if you are already trading futures or currencies and you've been trading for years and you have your technicals down, you're comfortable there, you don't have to relearn all of that. You're just expressing a view a different way. You're doing that with defined risk. And I think one of the things that makes Nadex unique, and I think a lot of our participants are starting to see, is that no matter the market conditions, they can be the most volatile to the most docile, and there's an opportunity because of the structure of the contracts. I think Nadex is probably the only place in the world where I found that. I'd love for somebody to tell me I'm wrong on that one, but literally when we saw in March how people were trading and they were able to get into extremely volatile markets that you just couldn't trade for the individual, you couldn't trade, let's face it. You couldn't get into futures, you get your face ripped off. Options premium was super high. Opportunities there. If you have those super flat markets where VIX is just hanging around the 10, 11 range and nothing is going on, you can literally do a premium collection strategy on a binary option on an intraday basis. You can also do that so when those markets go from that gentle little bunny and it turns into that bunny or the rabbit from Monty Python, you're not going to get your face ripped off on that side either, because it's all defined risk. You put up the full amount of collateral. It's just really fascinating to see how people discover this, how they take the approach to the market, because with all of the different people, so many unique approaches, so many unique strategies. I'm really looking forward to interviewing some of the winners and seeing what strategies they were utilizing. Mm-hmm. But a lot of fun. We're sending out a daily leaderboard. Very, very exciting stuff.
Dan, what else? I know you have some other opportunities and programs you wanted to mention on this podcast.
Yeah, absolutely. So coinciding with our demo trading competition, we've got a few bonus offers. The first one is the Refer a Friend, which we've been running for a while. It's really a way, I mean, our best marketing comes from people that are happy with Nadex and their experience they're having here. And so why not reward them, right? So if you have an open active account at Nadex, you're a Nadex member, you can refer up to 5 friends. We'll give you a dedicated tracking link. To get that, you just contact customer service at nadex.com, give you a tracking link. If your friends come in, open a live account, place 5 trades in 30 days, you both get $200. So it's a pretty nice offer. Rewards you as well as the friends. And again, you can do that up to 5 times. Also have a couple of deposit bonuses, which for me, when we look at trading, and I've been really in the last 20 years dedicated to the individual trader rather than institutional throughout my history. And one of the things I've seen as a big mistake is people will typically come into markets underfunded, right? They get really excited and they get a small amount of risk capital built up, and it kind of puts them at a disadvantage. So we know that a little bit bigger deposit can actually help people last a bit longer to get in. They can actually follow good risk management principles. And so how do we drive that behavior? And one of those that we're doing are initial deposits. So if you're new to Nadex, come in, you open up an account, fund with a minimum of $250, place 5 trades in 30 days, we'll put a 10% bonus on. The higher you fund, the greater the bonus. And so driving that behavior, 10% of your initial deposit up to, we'll credit up to $100. We've also had a lot of changes over the last 12 months, launched a new platform, brand new website, a lot of education materials. If you're somebody who was trading with Nadex more than 12 months ago, we have a lot of people coming back from 3, 4, 5 years ago. We've changed substantially, a lot better user experience. For those people, we'll also do the same type of bonus credit. So fund with reactivation deposit of a minimum of 250, 5 trades in 30 days, and we'll match 10% up to $100 of a total credit.
Dan, I appreciate that. That's exciting stuff. Hopefully the folks take advantage of it and look at the website. Thanks for joining us on the macro setup. And Dan, Nathan, before I close this out, any final thoughts?
Yeah, I just think that, we know a lot of the listeners are trading a lot of the products on a short-term basis, as Dan Cook just described here. And I think one of the things while we have these kind of broad macro conversations is that you need to have a framework, right? You need to kind of think about the world from up here, and then you need to start thinking about it on a micro level and the products in which you want to express that views. And then it comes together with a sort of time horizon. And I think that, the combination of their products and their capabilities and their system and the sort of opinions and the kind of knowledge we're trying to impart, I think it all has to find a place meeting in the middle. So I think these trading competitions are a great way to kind of achieve those goals. So Dan Cook, thanks for coming on and explaining that. And back to you, Guy Adami. Great chatting with you.
Thank you, guys.
Again, thank you. I'm sorry. Thank you, Dan Cook. Again, Dan Cook, head of business development at Nadex. I think you folks should check out some of the opportunities that he just outlined. Obviously, on behalf of Dan Nathan, I want to thank Peter Boockvar. Dan mentioned the book report, but folks, you should check it out because Peter does extraordinarily thoughtful work, and I mean that. That's not hyperbole. So on behalf of Dan Nathan at Risk Reversal, I'm Guy Adami at Guy Adami on Twitter. I want to thank you for for spending time on this week's macro setup, brought to you by our presenting sponsor, Nadex, the premier U.S. exchange for trading binary options, knockouts, and call spreads. Dan, I'll talk to you later.
See you, bud.